Welcome to the presentation on impact of crude oil prices on the performance of Indian Oil. Among the public sector oil marketing companies, BPCL and HPCL rank second and third with their share of 27% and 26%. IOC is the leader by far with a share of 47%. It operates 11 out of 23 public sector refineries and has got largest integrated network for petroleum distribution across the country. 12 months after the COVID crash, NIFTY rose up and it gave a return of over 70%. Unfortunately, IOC is found lagging at 20%. What compelled IOC to be such an underperformer? The impact of poor financial performance is always there on the share price. As we see here now, the profit falling from 33,000 to 24,000 to 3,000 crores. And then quarter by quarter, the first quarter of June, there is a further fall of 2,173. But face savers are the subsequent two quarters with addition of 8,000 crores roughly in the September quarter and 4,000 in the December quarter. Even with that, the profit is coming up to the level of 12,571, which is a tall order as compared to the earlier levels of 33,000 and 24,000. When we consider profit as return on assets, and the returns have sadly fallen from the level of 16% to the low of 2.6% and then slowly rising to the extent of 5.5%. But this definitely impacts the share price. Financial performance has affected the share price, but the share made double bottom in June and October, and thereafterwards its movement was along an ascending channel which was quite positive for the stock till March, when the candle started downward movement. And it is also suggested by the stochastic RSI, MACD and also OBV, and that makes us think, was there any additional impact of crude oil prices on the IOC stock price? The chart of crude oil WTI futures clearly indicates an ascending channel from November with its top value at 68 and the bottom base at 58. Long-term moving averages of 53 and 49 for 100 and 200 days, which confirms the trend is here to stay. And the basic reasons behind this trajectory and confirmed upward movement is the steady fall in the value of dollar, continued stimulus encouraging the spending and investment, and prominent reason is the refusal of OPEC members to enhance the supply of oil. And besides this, with the vaccine making its entry, there is global economic recovery which increases the demand for fuel naturally. With these things in the background, it is expected by the end of 2021, there is no wonder if the price crosses $70 per barrel. What of India? 84% of our demand is met by imports, means Brent crude prices directly affect fuel from the oil marketing companies. This is the area where the OMC operates by importing crude oil and paying ocean freight. It incurs operation costs and refinery processing costs. And after the decontrol, there are three concepts here now. Inventory gain, which is the price difference between the date of buying and the actual conversion or refining. There is refining margin of 3.3 per barrel, which is value addition, and a marketing margin allowed to be added to the final price. These are all the domain of OMC, which also incurs logistics and freight. When all put together, it forms about 36% of the overall price charged to customer, to which 37% comes as a charge of excise and cess from central government, 4% from dealers commission, and state government VAT is 23%. All put together becomes 100% of the price. This is based on petrol, but it is only for illustration purpose. And customer at the current price level will resist any change in the prices. This is the point we have to bear in mind. But what happens is, with the Brent going up, OMC ends up paying more for the same oil, which has to be either built into the price or it has to be compensated by the governments. But customers will not accept any more addition to the price. He refuses. Central government says it is a part of its income, it is not going to change, so also the state government. And in the process, what happens is OMC has to grin and bear it. And this is the crude joke on the margins earned by IOC going down the drain. IOC will get punished by the market by way of lower market capitalization because of its lower profits. And this will continue till the crude oil price stabilizes and starts its movement downwards. IOC, one of the largest integrated units under oil marketing companies, and its performance has been good in the past but affected badly by COVID and subsequent events. But the spiraling fuel prices has been a worry of Indian Oil, which hurts its interests. Unfortunately, crude is heading higher and that is posing additional risk to Indian Oil, and that will be a burden on the marketing margins, which will remain squeezed for a long time to come. With the squeeze on profits, market capitalization of IOC is likely to suffer, and so also its market price, and that puts Indian Oil in a very tight spot. Hope you liked the video. You can access similar videos at the info card on stock learning, and may kindly like the video, share it, and if you are a new visitor, kindly subscribe to the channel and press on the bell icon for timely intimation on resourceful videos. Thank you so much for your time and highly obliged for your attention. The video is for purposes of information, education and awareness only. This is not a solicitation or recommendation to buy, sell or hold securities. Kindly seek the advice of a competent professional as necessary.